Hello everyone, and I hope that you are well, and welcome back to the channel. And as always, I want to say thank you to everyone who's supported us over the year or so, and growing this channel. I think we hit 15,000 subscribers today, which is incredible. It's not what I expected at all. So yeah, thank you to you guys. Anyway, in this video, what I'm going to hope to do is give you a set blueprint that you can follow and incorporate in your own trading. Now, the whole idea with rule-based trading is, so I'll write these down. Well, I don't know why that's so big. The whole idea about rule-based trading. So let me make that smaller. There we go. Okay. It takes away the emotion, and what I mean by that is because you're only waiting for set rules, okay? And if the rules aren't present, you don't trade, and if the rules are there, you take a trade. It doesn't matter. There's no thinking about it, so it takes away the emotion and it takes away the doubt, okay? And it also allows you to trade without that discretion. There's none of this guesswork. So let's say it removes the guesswork. Now, the reason why I want to talk about this is purely because what I've noticed is, and especially what I've seen in the Reddit page as well, is people asking questions on which POI is valid and so on. And the thing is, that question is so what's the word? It's so vague because there's no definitive answer into how which POI is going to work or not, because in terms of trading with an OB is always valid unless it is mitigated or violated, right? It's going to happen, one of those two things. The question we should look for is which POI should we be trading from at that moment in time. Now, with strategies, what I've seen is with various strategies there are several types of entries. The problem with that is, say if you're looking for like an entry type 3 or entry type 2, you're going to miss like entry type 1 or entry type 5 playing out right in front of you, purely because you're so fixated on those other two entry types. And what we do at Vertex is that we have such a rule-based system that we have a set set of rules that we need to play out. Otherwise, we don't take the trade. And what I'm going to give you guys today is a basic rule set. Well, hopefully I'm going to give you guys a basic rule set that you can apply to your own trading, okay? Now, what we already understood what we should have learned from this channel already is the idea of liquidity, and you should understand order flow as well, okay? So, in terms of liquidity, we know that liquidity is sitting above every single high and every single low, okay? And every time like a low gets broken, liquidity is being taken, and then when a high gets broken, liquidity is being taken, and so on, right? That's what fuels the market, and that's what's allowing people to take a trade, buy and sell, from POI to POI, okay? Now, the thing is, with this way of thinking is, we don't know, it's sort of like guessing, you're sort of guessing where the low is, guessing where the highs are, and so on, because it doesn't really give you a clear rule set into how to actually enter when this situation happens. And a lot of us have the knowledge and understanding about structure and liquidity, but then when it comes to actually trading live, we don't know what to do, purely because you're thinking about so much, you don't actually know what you're looking for, even though you understand it. And that's a weird part when you're learning. I had the same problem, which is why I needed to develop a set of rules in order to learn, right? And in order to find some sort of consistency, because there's too much thinking, and smart money concepts is not easy at all. Okay, there's a lot of complexity to it, but we can simplify it to as much as we possibly can, right? So now that I've discussed liquidity. I'm not going to go into liquidity in too much detail because I've done a video already on that. What we also need to understand is how order flow works. And order flow is basically mitigation, right? You have mitigation, and continue. Okay, generally you have like 1 to 3 mitigations, then you have a full release. That is order flow. Order flow is a process of mitigation. Now, what I'm going to show you is how we can combine the two and give you a set criteria for you guys to look for in your own trading, okay? um, and hopefully it can help you guys, take away some of the doubt that you guys have. Okay, because from the conversations I've had with some of you guys, you understand the concepts, but then you're thinking about too much, and it depends on the way you think, I suppose. But the way I think, it needs to be completely simple. Otherwise, if I'm thinking too much, I'm doubting the setups, and then I realize I missed the trade and I don't take it, and so on, and I take losses, and I've been through all that. Anyway, so I'm going to draw it, and then hopefully I'm going to find. The thing is, I've stopped trading last week, so I don't actually know what the market's actually been doing. I've only seen charts. Like the charts that students have sent me and the journals that I've seen, I've not actually seen any charts since last week. But I thought I'll have to do a video at some point, otherwise you guys will get no videos until January, because as you guys know, I like to do videos on trades that I've actually taken rather than giving you, made up trades or like what people call cherry picking. However, until the new year, these trades I'm going to show you are basically me cherry picked trades. But to be fair, I've not actually seen the markets recently, so I have no idea what I'm going to show you today anyway. But let me I'll give you a drawn example. Okay, so let's say the basic idea of liquidity is when you have like a ranging market, liquidity is building up high and down here, right? Then you have your liquidity grab, then you have your impulsive move. Okay, so what we have here is we have our liquidity grab. That's going to be our rule number one. I'll write these again at the end, and hopefully when I find you an example. Okay, so we have our liquidity grab. What we need next, we need an impulsive move with high momentum that goes on to break structure. That not only confirms the liquidity grab, it also confirms the OB that we're going to look for. Now, this gives you an OB, right? OB, IFC, IPA, SC, whatever you want to call it. It gives you that candle or sponsored candles. That's what SC is, isn't it? No, yeah, SC. What that gives you, it gives you an area that you can actually enter from. Now, you can set an order straight here if you wanted to. However, you need to understand that this is somewhat high probability given the fact that you have that liquidity grab. And I think some people call this a change of character, which I've seen dotted around all over Instagram, to be fair. It's just an impulsive move which breaks structure in the opposite way. That's literally it. Okay, so when we have this, you can enter straight off there if you want to. However, for me, it's not high probability enough. We use our inception model ourselves in this criteria, in this sort of scenario. It was actually this time last year during my winter break where the inception model was actually created. So, who knows what this winter break will develop, because as you know, I'm always looking to refine and improve the strategy to as much as I possibly can. The inception model has been a game changer for us anyway. But yeah, I won't I won't talk too much about that anyway. So what we can do is you can place your order here should you wish. It's completely up to you, and this is what determines what kind of trader you are, because it determines taking a trade from here is determined by your risk tolerance, whether you want to take the trade from here or not. I personally wouldn't, purely because you don't have order flow. So although we have structure and liquidity, we don't have order flow. Order flow is being created here following a mitigation, and then what happens when we have the break of structure? What we have is mitigation play, and now we have a new POI. Not only do we have this creates a rule set for where to place your stop loss, because this gives you an invalidation point as your last mitigation point, right? So that means you can safely place your stop loss just below it because you have that point of invalidation. So what that means is you can place your order directly here if you wanted to, okay, and take the trade to continue, because that's what's expected because you're creating order flow and following it. The thing is, you can set an order straight here, but you need to understand, and this is something that we need to all grasp, is the idea that regardless of how good an edge is, it will lose at times. Okay, as long as you understand and get rid of the thinking that your strategy will always win, you can trade in a more comfortable way, because when you trade in a rule-based way, you need to accept the fact that your rules may work out sometimes and it may not. As long as it's an edge, because it needs to be above 50% win rate for it to be an edge in the market, that's an edge. You just need to play it out in the long run. It will play out. The difference with this strategy is that the risk to reward is a minimum, what, 1 to 5, 1 to 10. It sort of allows you to have a lower win rate. However, there's ways that we can increase it, okay? And that's another thing that we have. So we have a rule set for our structure, our entries, and we've got a rule set for probabilities as well. So, you know, trading with rules, you know, you're only looking for that one thing. There's not much thinking involved, because you're looking for your set criteria. Now, it's up to you, as I said, if you want to take this trade directly off here. Obviously, we have our confirmation model to continue. Now, this is where it gets a little bit tricky, because sometimes you have this. Sometimes you have situations where you have liquidity being built, liquidity taken, and then impulsive move. You have your mitigation, and then you have a breaker structure, and you have your POI. Now what happens is sometimes you create like new highs, for example. What this does, it creates more POIs that you're having and you're thinking where to trade from. But then what happens, price crashes down, comes back to the mitigation and carries on. What's happening here is the fact that this is liquidity being built. Okay, liquidity is being created here. So the confluence behind all of this, and this is going to be your the trading model and blueprint that I'm giving you, is the fact that, so we have our liquidity graph, rule 1. Rule 2, we have the impulsive move with high momentum that goes on to break structure. Okay. Rule 3, we need the mitigation play. And then our entry is going to be based off that mitigation. Whatever happens above here, it doesn't matter, because we are looking to trade where the mitigation is taking place. Sometimes you get mitigations up here, and if you do that, you can take a trade from here, but you need to think where order flow was created. This is all liquidity that's being formed. Okay, now it's all well and good looking at a drawing, but let me try find you an actual chart example. We'll be on Euro USD. Let's go. I'm sure something in a minute. So let's go to this morning. Okay, I think we've got an example here. As I said, these aren't trades I've taken, so it is somewhat cherry picked. Let's go to here. Well, I haven't seen the market myself, so I don't really know how this plays out or where this reacts. I just seen that we do have a bullish move anyway. But I just saw this. So let's talk about our rule sets, okay? So we have rule number 1 is we have our liquidity grab, which is here. Rule 1 is, I'm going to say LG, oh, not LQ. LG, which is our liquidity grab. Let's make that a bit smaller. There we go. I think what if, depending on how clear this turns out, I think I could probably post screenshots of this, or you guys can take screenshots of this video. Okay, so we have rule 1, we have our liquidity grab. Okay, now what was rule 2? Rule 2 was an impulsive break which goes on to break structure with a lot of momentum. That's exactly what we have here. So we have rule 2, which is impulsive break, momentum. Okay, we have that. Now what we need is rule number 3, which is a successful mitigation. Now, as I said, you can take the trade straight off here should you wish. I personally would not feel comfortable in terms of probability sake, because I'm a bit more cautious as a trader. If you want to take this trade, you can, because it is somewhat high probability because you have the liquidity grab and you're taking a trade straight off that. However, for me, that's not enough. Okay, for me, that's not enough confirmation. So let's see what happens. For us, because what you probably see is when you see some of our trades, I do take trades off this, off the first POI, but that's because we have our own rule set in how to confirm using the inception model to increase our odds. That's the only difference, which I'm not going to show you here, obviously. But if you are going to take the trade straight off here, just bear that in mind. It's not as high probability. Okay. What we can see here is now we have rule number 3, which is our mitigation, which is our order flow being created. Did I spell mitigation wrong? Yeah, I did. I missed the I. There we go. So this is, oh, not rule number 2, rule 3. Sorry. There we go. That's rule 3. So now we have our mitigation. So let's go on to break structure. Okay. Now, this is a good example because I suppose it's not quite clear where to trade from now. However, this is where your understanding comes into place of, how price moves in the market. Now, when you have the situation where your last mitigation point doesn't really form an OB, what you should be looking for is where the last point is, where the last candle is before the imbalance that creates that whole impulsive move. That last candle is this one here. But what's also interesting me here is that wick that's next to it. This one here. The reason why I'm saying this is because this wick is quite big in comparison to the candle, right? What actually happens is when a candle creates a wick like this is what's actually happening inside. So we know a candle, so this is a 1 minute candle, is created of loads of little candles on lower time frames, right? When a candle is doing this, what's happening? So this is the candle before. Let me put this above. There we go. What's actually happening is that price is flickering like this and then it closes like this. For price to close like that, for the candle to close like that, what that needs, it needs a high momentum move to push that up for a price to close out like that, okay? So what does that mean? It means that this is where the buyers are entering the market in this position here. Okay, so this alone is a POI. Now, you can comfortably trade straight off this. Now, if you're going to trade like this, okay, and this is another rule set that I forgot to give, is this. When we have that mitigation point, what do we have? We have a point of invalidation. So that's our rule set for our stop loss. Now, if you're going to take a trade straight off from here, you need to make sure your stop loss is protected, okay? Now, to protect your stop loss and to trade it with high probability, you want to put your stop loss below the invalidation point, okay? Which give you a 3 pip stop loss. I don't know what, you could probably have tighter, 2.5, okay? Let's say that. You can take the trade straight from there. Because for me, that's the last point of validation, not last point of validation, that's the last point before that impulsive move, which goes on to break that structure. But my stop loss needs to be secure because there still could be valid POIs within here to trade from, okay? But it's not clear on this time frame. What also you can do is, if it's not clear, just refine it even further. Go to a lower time frame. So let's go 30 second. I think, probably this candle. Let's go 15. Actually, let's look at the structure on this. 30 second structure, break from here, mitigation. Okay, so is what we have here. This is quite interesting. So we have the low, we have the high, and then we go on to break structure, okay, from this candle here. But then what we have is a form of mitigation, okay, and then we have this whole impulsive move. So this forms a small invalidation point here, okay? But I think when I flicked to 15 seconds, I think that was clearer. Yeah, okay, this is clearer. So in this situation, what we have is the low, we have the high. This high eventually gets broken here, okay? So we have this high gets broken here, and then we create this high. Then we have this mitigation point because this low created this high, okay, from this OB here. This whole, let's say that's the whole OB. We have mitigation and then we have a new high being formed, low, high. This is why I said in terms of the new creations of new highs being formed and new higher lows, it doesn't matter because all these is just liquidity because the mitigation point is here, so order flow is here. So what that gives is this now gives you there we go, this now gives you another point of invalidation here. So now if you wanted to, so for me, you can take a trade straight off from here, from that candle, I don't know where it reacts, and say, what can I give you, a 1 pip stop loss on this one, okay, because you have that point of invalidation on that lower time frame. So you've just made that 3 pip stop loss into a 1 pip stop loss. But let's see where price reacts anyway. Okay, and this is another example actually. So what I was talking about is we have. Sorry, I don't like moving the chart so much. There we go. We have obviously new highs being created, and this is where people get stopped because they don't know what to do, because you're having new structures being formed. Where do you take the trade from? The thing is, there's nothing to confirm these OBs, because OBs that break structure, right? They're the candles that break structure. But you need to think about your confluence. Your confluence is the fact where liquidity is being grabbed, which none of these have done. And you need to think if it's mitigating anything, which none of these have done. So in that case, you need to think that these are just forms of liquidity, which is why taking the trade off from following the second mitigation gives you the highest probability setup. Okay, let's see where it does react anyway. Yeah, perfect. So it reacts perfectly, and you get your. Does it get to 1 to 10? Yeah, you get your 1 to 10. And I think, yeah, you get your 1 to 10, and then you can continue. Now, bear in mind, this is like going into Frankfurt and going into London, so I don't know how far the move will last, but this is just an example. And as I said, you can use this on any time frame that you want, right? Now, what I was trying to achieve from this video is giving you a blueprint setup that you can look for. Now, the thing is, the way that we trade in Vertex, we are looking for a set criteria, and if it's not met, we don't trade. If it's met, we trade. That's just how it is. You know, what I hopefully give you is this will hopefully get rid of that doubt that you guys will probably have in terms of where to trade from, because now all you're going to be looking for is these three things, and now you can continue to look for your trades as long as this is being created. You can do this on any time frame, not just the minute time frame. I only chose the minute because I thought there's most likely going to be a situation, which there was, which worked out in the end for this video. But you could do this on any time frame. The whole principle is the same, because you need to understand that, you know, the market is fractal. And as I said, I think I'll post screenshots at some point for you guys for this video, but I'll let you digest the video content to start off with. You know, the only difference that we have at Vertex is that we have a whole rule set to take a trade, because I like to catch trades from here. Okay, and given the size, given where this wick comes come back to, I most likely would have entered here. Okay, and this would have been our second entry should we want to get that. That's the only difference, because we have our confirmation model and our inception model to give us a high probability setup right at the apex. The reason we want to do that is because if you're trading lower time frames, you want to catch the move, you want to catch the most you can from a move, from like a 10 to 20 pip move. You want to catch the most you can from that, because if you're catching like the impulsive moves, generally happens in 10 to 20 pips or so, and then it's over. You know, then you have a fat retrace. That's the whole idea behind it, with how we trade. But I hope this video gives you a set rule set. So the whole rules is you want to find that liquidity grab as your rule 1. You want to have the impulsive break as your rule 2. You want to have the form mitigation as your rule 3, and then you enter following that. The difference, the way that you guys would differ as traders is how far you refine like this. Would you refine this far? Some people wouldn't. Some people would just place your entry here and your stop loss below this, which is fine. It's completely up to you how cautious you wish to be. For me, that gives you an extra layer of confidence because you have that point of invalidation on your lower time frame. That's just how I see it. But yeah, as I said, I hope this video gives you some clarity. As it is Black Friday coming up on Friday, obviously, we do actually have a £500 discount code for our bootcamp, which is BF500. And you can actually sign up via our website, which is going to be in the link below. So you can just go join now, and you have the bootcamp here. Obviously, we have our mentorship, which is our trade membership program. This is a one-off fee, obviously. But if you want to join and just to learn the rules, to learn how exactly we catch these moves from here, or how we catch the apex for the moves, you can actually just join the course program, which is this one. There's a little video explaining what you get, and then you can see a little bit here. But essentially, you get full access to the course. I'm active in there anyway as well. You get full access to the course, and you can learn the exact rules on how to take trades like we do. But for now, if that's not feasible for you, this is more than enough that you need, and all you need to do is just rinse and repeat this setup. I'm sure a lot of you are becoming profitable from the free content, and hopefully this gives you this hopefully ties in together liquidity and order flow in one video for you. But I'll leave you be for now, and I hope you all take care, and I hope you all trade safe.